This is Mike Swanson of Wall Street Window, and we've seen an interesting couple of weeks in the financial markets. We saw the stock market take a one-day hit a couple of weeks ago, but last week things sort of stabilized in the markets. But people were wondering, when is the next bear market going to come? Well, that's a question that I attempted to address in a newsletter update that I'm just putting out. So let me show you the update. To get it, subscribe for free to my newsletter at WallStreetWindow.com. Just go to WallStreetWindow.com to subscribe. But before I get to the US stock market, I want to point out that gold is also trying to stabilize and form a new support level off of the $4,000 an ounce mark, which is the area I've circled in this chart right here. Now, gold had a tremendous run since August. It's in fact doubled in price in the past 2 years. Silver right now is basically the same chart as gold. So it is the same position as it is. The logical thing to do would be expect both to enter a sideways trading range like we saw gold do basically from April to Labor Day for the next couple months to digest the gains, to consolidate. Precious metals rallied hard into that September rate cut, which is kicking off a new cycle of lower interest rates. So in a certain sense, part of what happened in September and October was a buy the news and then sell it, which is something a lot of traders do. It's not what I'm doing as a investor in gold that has owned it for much lower levels than where it is now. But one key thing going on in the financial markets is what's happening in the bond market. Bonds are rallying. The lowering of interest rates seems to be helping that continue because people want to lock in current yields before rates go lower. So someone might have a money market fund, let's say, and they want to take money out of that and lock in the yields by buying bonds. As a result, some of the ETFs, such as JNK, have gone up. A JNK is an ETF for junk bonds. This is important because I don't think we're going to see a U.S. Bear market begin until this rally in the bond market comes to an end. And bonds are likely to peak out before that next bear market in the U.S. stock market occurs. This is actually what happened in 2022. What you're looking at here is a chart of the LQD high grade corporate bond ETF. And what I want you to notice is that right now it's going up, it's rallying. But in 2021, this ETF peaked out in the May-June period and slightly trending down. At the same time, the stock market continued to rally into the end of the year of 2021, but then both took a hit and went into vicious bear markets. But the peak in LQD preceded the peak in the stock market. Weakness in the corporate bond market preceded the start of the bear market that really smashed both in 2022. Now, when you look at the chart, you see the SPX on the bottom of this, that's S&P 500. You know, it's gone up so much since then that what happened in 22 doesn't look like much. But it was a 25% decline in the S&P 500. And bond funds took big hits too. The typical 60-40 U.S. stocks, U.S. bonds portfolio allocation that most American investors have, they think of stocks as risk, bonds as safety, was a total disaster in 2022 because both fell. When the next bear market does happen, the U.S. Stock market, I think the bond market will go down also. And that's why, one reason why gold is so important now for people to own in order to be diversified for that next bear market in the U.S. stock market. It's not simply that gold is going up or gold's momentum play, which is true, but it's a necessary investment for people to be diversified. And that's one reason it's going up, because more people are catching on to that reality, just as central banks around the world have been accumulating gold for the past several years in the reserves. Now, U.S. stock market internals at the moment are starting to falter. This is a chart of the percentage of stocks above their 200-day moving average trading in the New York Stock Exchange. It's a measure of the internals of the market, so to speak. And this indicator has been going down a little bit since Labor Day, while the market has continued to go higher, while the average is continuing to go higher. That's happening because the rally is getting narrow and narrow and narrower, and there's some stocks and sectors actually in decline. If you look, for example, at gambling stocks, casino stocks, they're not doing very well. But of course, NVIDIA and then those wonder stocks that everyone talks about are. But this is important because weakening internals precedes a bear market, because eventually these leadership stocks peak out too. However, it takes time for that to happen. It could take even up to a year for that to happen. Now, in 2021, the internals also peaked out around March and continued lower, and they actually had a rapid deterioration in the fall of that year, which confirmed the weakness you were seeing. Something's wrong with these bond funds, ETFs, but the internals for the stock market were rapidly weakening. Huge warning sign that a bear market was coming, and that bear market began in 2022. Now, the internals are not in a rapid decline, but it could be that they peaked out just as they did in February or so, 2021. Now, that peak in the internals in 2021 coincided with that GameStop, AMC mania that hit the mainstream media, created celebrities out of that so-called roaring kitty celeb guru that became a sensation. He was a social media personality. So that was an interesting thing. The moment everyone got the most excited that year about the markets and trading was the moment the internals actually peaked out. To summarize what all this means, look, when I look at the charts and all this, I can't tell you anything that makes me say we should expect a bear market. It would take an event out of right field, that upsets the apple cart, a war somewhere that affects the United States. Something huge would have to happen. Otherwise, expect the momentum and the averages to remain positive. And I don't think the next bear market is happening and this bond market rally ends. And I don't think that's going to happen to sometime next year. So that's my overall outlook. Now, I want to remind you, though, that gold did well in 2022, and I expect it to do even better when the next U.S. bear market does hit. So again, I'll just reiterate, gold's not just a play on higher prices, but it's a safety play for your portfolio for the long term. And I know no one thinks about this kind of thing. Everyone thinks about price momentum, and because of all the years of that being promoted on social media, that's how it's trained people to think. But I think you need to think as a serious investor too. This is not a get-rich-quick scheme. Those who get caught up in meme trades, meme stocks, just like they did in 2021, end up buying at peaks, especially if you have no game plan or strategy on what you're simply doing. Then you simply become somebody who's chasing price action or simply relying on the predictions of others. And no one can predict this thing. I'm not trying to predict this thing. I'm just telling you what I see in the trends right now. And there's nothing I can tell you in the market structure and the trends to make me tell you that we're having an imminent bear market. But I have to keep looking at these things to be on top of them. So if that day comes, I can tell you about it. And to get the newsletter again, it's free. Go to WallStreetWindow.com. If you want more videos like this, hit the like button and I'll know to do more of them for you. And I'll be talking with you later.